Physical Gold Fund presents The Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. Welcome to part 2 of the latest podcast from The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund.
Well, let's come back here then to the United States for a minute for our next thought, and that's about what's going on with the Federal Reserve. There's, once again, even more euphoria about the economy. The latest job reports, a significant rise in new jobs, a drop in unemployment figures, and this is leading naturally to talk about the Federal Reserve raising interest rates. And it seems to have dampened enthusiasm in the stock markets a bit, the thought that easy money might not be going on for very long. And I feel as if I've asked you all these questions before, but here we go again. In this context, will the Fed announce a rate rise at the upcoming FOMC meeting? And if not, why not?
Well, I think we have discussed it before, John, but it's one of my favorite topics because I've been able to strike out a little bit of a contrarian view on this, and I'm happy to kind of update the listeners. I will say that whenever I'm in a seminar like this or asked to give my views on something, I always give my my best, most thoughtful, up-to-date view. But new stuff comes out every day, and so one of the benefits I think of this webinar series, the Gold Chronicles, is we do them once a month, and it is a good opportunity to update. This, by the way, is one of my analytical techniques. It's called inverse probability. It's how you analyze things, or I should say how I analyze things. We do this in the intelligence community. It's done elsewhere. It's not usually done on Wall Street. It's certainly not done at the Federal Reserve. But the way I do things is a lot of the problems you confront are what they call underdetermined. Underdetermined just means it's a fancy way of saying you don't have enough information. So the statistics geeks, build models, take the data they have, crunch the numbers, come up with forecasts, and if you're the Fed, you're almost always wrong. I would actually say always wrong. I haven't seen a good Fed forecast since I can remember. But the inverse probability technique is a little bit different. What you do is you're candid about the fact that you don't have enough information. So you come up with a hypothesis based on whatever you do have, whatever scraps of information, but also use other things, intuition, history, things that statisticians and 160 IQ finance PhDs don't like to talk about, but they work pretty well. And then do the hypothesis first, and then test it against the data every day and challenge your own assumptions. And if the data is coming in sort of confirming what you thought, then you strengthen the hypothesis. And if it goes the other way, you throw it away and come up with something else. So I've said since last year, not in prior months this year, but going back to 2014, that my view, the Fed would not, and I would say could not, raise interest rates in 2015. So far so good, but it's early in the year. We'll see what happens. Now, I base that on a couple of things. Number one, let's go all the way back to December 2013. That's when Ben Bernanke started the taper. Remember, Janet Yellen did not take over until January 2014. Ben Bernanke was still chairman in December 2013, and he started the taper. She finished it. She saw it throughout 2014, but it wasn't her idea. I'm sure she was on board, but it was Bernanke's idea. And then they kept tapering throughout 2014. Now that was based on an assumption that the U.S. economy was getting stronger, that growth was pretty good, and they said we're going to do the following sequence. First, we're going to taper, meaning reduce and then stop long-term asset purchases. Then we're going to pause. Then we're going to raise rates. Then we'll raise them some more. Then we'll start to reduce the balance sheet, and we'll all live happily ever after. So that was the sequence, and it was a multi-year sequence. Well, they did the taper, but as they say, a funny thing happened on the way to the forum, which is that by the time the taper finished in late 2014, the U.S. economy was already showing signs of weakness, and those signs of weakness have become a lot more visible, a lot more apparent by now. Certainly January, February, March so far, a lot of the data is coming in really weak. And then another thing happened, which they didn't anticipate, which is, okay, the whole world's easing. Europe has QE. China reduced the reserve ratio requirement. They cut interest rates twice. There have been 23 central bank rate cuts in the past 2.5 months. 23 central bank rate cuts in the past 2.5 months. This is the currency war on steroids. So what you have is this massive rate cutting around the world, massive ease around the world. And here's the Fed the lone central bank, except Switzerland, I'll put Switzerland in a separate category, but the Fed is the lone central bank saying, you know what, we're going to raise rates. Well, guess what that does to global capital flows? It brings them to the United States. So if you've got capital anywhere in the world and Europe's paying you nothing and China says we're going to pay you less and the US says we're going to pay you more, that capital is going to come to the United States. So what does that mean? Well, the dollar gets stronger because people are dumping emerging markets currencies, dumping the euro and buying dollars. So, because they want the dollar return that they see coming. So that's a strong dollar. What does a strong dollar mean? Well, it's deflationary. What is the Fed's stated goal? The Fed says we have an inflation goal. So let's think about this for a second. The Fed says we want 2% inflation. That's not a secret. The Fed says that all the time. Then they say we're going to raise rates, or certainly strongly implying they're going to raise rates. They've given markets no reason to think they won't raise rates. So we want inflation, we're going to raise rates, but raising rates makes the dollar stronger, which is deflationary, and pushes the Fed away from the inflation goal. So how does that work? Well, the answer is it doesn't work. If you actually go down that path, you will get the stronger dollar, you will get deflation, you will be defeated in your inflation goal, and you may actually have to cut rates later, which is a complete loss of face and loss of confidence. I already know the Fed doesn't know what they're doing because Fed governors have told me privately they don't know what they're doing, but that would just tell the whole world that they don't know what they're doing. Or even go to QE4 in early to mid 2016. They don't want to do that. So they're between a rock and a hard place. If they actually, get my expectations, they will not raise rates. But let's just say I'm wrong. Let's just say they raise them. Okay, if they raise rates, look out below, because that's just going to accelerate and exacerbate the trends that I've just described. It's going to be more deflationary. By the way, deflation is hurting the overseas earnings of U.S. corporations. If you make money overseas, but you're a U.S. company, you report in dollars, right? So if you have to convert those overseas earnings back into dollars when the dollar is stronger, that's going to reduce your earnings. What's that going to do to stock prices? It's going to take them down. What's it doing to the bond market? Yields are going down because deflation is getting worse. So, you got bonds going up, stocks going up, dollar going up. Everything's going the wrong way for the Fed, at least in terms of their inflation goal. And that's what's going to happen if they raise rates. So this is all going to come to a head next week, because the Fed has a meeting and there's a press conference. And the big debate is, by the way, this shows how ridiculous things are. I mean, why are all the smartest people in the world, having sleepless nights over the word patience? But the question is, will the Fed remove the word patient from the statement that they release after each FOMC meeting? Because they've said that they will not raise rates until 2 meetings after they take out the word patient. And just follow me on this. So, okay, so there's a meeting in April and there's a meeting in June. So if you want to raise rates in June, you have to take out the word patient in March, so that 2 meetings, April, June, boom, you can raise rates in June. So if you want to raise rates in June, you have to take out the word patient in March. But here's the problem. If they take out the word patient, right, they're thinking, well, maybe we'll raise rates in June, maybe we won't. That gives us a free option. But we all know what the markets are going to do. The markets are going to anticipate it as you will raise rates in June. So markets always discount. They bring the impact forward. So taking out the word patient in March is equivalent to a rate increase, because the markets will assume that they're definitely going to raise them in June, and then they will discount it back to March, which is only like 60 days at a zero discount rate. So that's the same thing. So it's the equivalent of raising rates in a world where the dollar has gone to the moon. I mean, the dollar hasn't been this strong in 12 years. But if they don't take the word out, they leave the word patient in, then the markets are going to go, oh, well, now you can't raise them in June, so let's look at July, And so this game, the Fed keeps painting themselves into a corner. They seem incapable of thinking 2 moves ahead. They can barely think 1 move ahead because they got to make a decision by Wednesday, but they are incapable of thinking 2 moves ahead. But they paint themselves into this corner. This is what happens when you manipulate markets. You have to keep manipulating just to keep the whole thing from falling apart. So I don't know if they're going to take out the word patient or not. This is just my gut. My gut tells me that they're going to leave it in because they can see this train wreck. I don't want to put a stake in the ground around that. They might take it out. But I do feel strongly that if they do take it out, the dollar is going to spike, the bond market's going to rally on that, stocks will go down. And by the way, this is a fiasco for emerging markets, because emerging markets, let's look at it from their point of view. I've been talking about the impact of the Fed on the dollar and U.S. stocks and U.S. bonds. Let's go overseas. They're short dollars. They are short $9 trillion. They're $9 trillion approximately of emerging markets dollar-denominated debt, corporate debt. That's not sovereign debt. Put that to one side. It's not local currency debt. Put that to one side. U.S. dollar denominated corporate debt, emerging markets, $9 trillion. Well, if you're in Turkey or Indonesia or Mexico or Brazil or Korea or Singapore or Thailand, or for that matter, China, you can't print dollars. Your central bank can't print dollars, but you owe dollars and you make local currency. So to pay back the dollars, you have to get $9 trillion. That means you're short $9 trillion. This is what I call the big short. Michael Lewis had a very successful book a few years ago called The Big Short, which was about the mortgage crisis. And it tells the story of a few investors in 2006 who could see the mortgage train wreck coming. It was John Paulson, Kyle Bass, and a few others. And they could see it coming. They said, my goodness, this is the greatest opportunity of a lifetime. How do I short this thing? And they went to Goldman Sachs, and Goldman Sachs cooked up a bunch of derivatives. And, of course, they sold the other side of the trade to somebody else, but that was their problem. It's good old Goldman. But Kyle and John Paulson and others managed to put on the big short. John Paulson personally made $5 billion. That's not his investors. His investors made more, but he personally made $5 billion on that trade. So look around the world today. That was a $1 trillion trade levered up, kind of 5 to 1. Look around the world today. What's the big short? Well, you have a $9 trillion emerging markets short dollar position. That's without leverage. You throw some derivatives around it. I'm sure we could get up to 20 or 30 trillion without too much difficulty. By the way, that's 50% of global GDP, just to give you the order of magnitude. Don't think people aren't doing this, by the way. So you're Janet Yellen. You're sitting there in your little Fed bubble on the second floor outside the boardroom in the marble hallway of the Federal Reserve, and you got your little, incredibly flawed models that you learned at MIT. You're sitting there saying, we ought to raise interest rates. But meanwhile, you could be popping a 20 or 30 trillion dollar bubble. So this to me looks a lot like 1997, more so than 2008. 2008 might actually be small compared to what happens next. This looks like 1997. That was, that ended famously in August, September 1998 with the default by Russia and the collapse of long-term capital management. And I think we mentioned at the beginning of the call, I was general counsel of long-term capital management at the time. I negotiated that bailout, so I had a front row seat on that one. I know how these things go down. But that actually started in June 1997, over a year earlier in Thailand, where there was a loss of confidence and the hot money started to come out of Thailand dollars. People started selling the Thai baht, taking their dollars out of Thailand, and the central bank couldn't maintain the peg, so they broke the peg. Then that immediately caused contagion, i.e. loss of confidence in Indonesia, South Korea. I mean, it went around the world before it got to Greenwich, Connecticut, where we were. So something similar is happening today. I hope someone's explaining this to Janet Yellen. I actually hope she's listening. I doubt it, but I hope she's on the call. But if she raises rates, that's going to be the beginning. That's going to be a snowflake that's going to ripple around the world. And it has that kind of catastrophic potential. So let's see what happens. But I think they think that they can take out the word patient and act like nothing happens to June and they have a free option. I think that misreads the situation. I think the markets are going to say, you don't have a free option. We're going to treat it as a done deal. We're going to discount it to March. We're going to act like you just increased rates, and then this sort of cascade will bubble around the world. So it's a good time to own gold. It's a good time to have cash. I like bonds for the same reason, because in strong dollar panics or flight to quality panics, treasuries will rally. I may not like stocks. Now, but here's the problem, John. Let's say the Fed doesn't raise rates. Let's say they leave in the word patient. They don't raise rates. And let's say we get to June or July and the data continues to come in weak. They continue to remain patient. Maybe they call John Hilsenrath and say, we're going to be very patient. John's the reporter for the Wall Street Journal who gets the phone calls from the people at the Fed. And then he's a good reporter, he puts it out there. People like to beat him up, but the guy's just doing his job, right? And then they start to say, well, yeah, patient. We're actually going to be very, very patient. Well, if the market is pricing in a rate increase and the Fed doesn't raise rates, that's the same as a cut. Right? They can't cut because they're at zero. But if you've priced in an increase and they don't increase, that's like a cut. So markets could actually rally on that. Now, that rally won't be in the next couple of months. That's something that would probably play out over the second half as the Fed folds their hand. But the problem for investors right now is I can give you a scenario, in fact, I just did, where stock markets collapse based on the rate increase path. By the same token, I can give you a scenario where the Fed blinks, doesn't raise rates, and markets rally because it's like a rate cut. And that's not being wishy-washy. That's just being very candid about how the dynamics work. It's also a very good illustration of how the Fed should, just get back to doing their jobs and stop trying to micromanage the entire world. But so let's watch it very carefully. My view now is that we're going to kind of have the worst of both worlds, and what I mean by that is the Fed is not going to be able to raise rates for the reasons I mentioned, but they're going to keep acting like they can. So the markets are not going to know which way to turn. So we're going to get volatility. Again, I like gold here. I like cash. I like 10-year notes. Stocks, I don't want to short them because if they don't raise rates, they could rally, but you don't want to back up the truck either because if they do raise rates, there could be no bottom. So that's, I'll stop there, but that's kind of where we are.
It's an extraordinary story, and I was trying to figure in my mind, is this Alice in Wonderland or Gulliver's Travels? I mean, when the global economy stands or falls on the presence or absence of the word patience. That's totally bizarre. Well, thank you, Jim. But we do have some questions from our listeners, and here's Alex Stanzik with those questions.
Okay, thank you very much. I have to just make a quick comment. I was doing my best not to split my sides with laughter with the whole, I hope Janet Yellen is listening comment. That was really good. Okay, so we have a number of questions. As usual, we have way more questions than we probably have time to answer, but we've got about 25 minutes left with Jim for this webinar, so we'll do our best to hit them all in order of what we think are probably the most important to address. The first one comes from Jim L., and his question is, a large part of our funds are currently in money markets. I'm a Canadian. Is this a satisfactory place to be at this time?
The answer is no, and let me explain why. We talked earlier about how bank deposits are not safe beyond the insured amount. I think they are safe up to the insured amount, so I want to be clear on that. But beyond the insured amount, you're just an unsecured creditor. By the way, you can go to a too-big-to-fail bank. If you go to Bank of America or Citibank, they're in some ways the most reckless, worst-managed banks in the world, but our system is so messed up that the most reckless banks might be the place you want to have your money because they are too big to fail and they're the ones that are least likely actually to collapse. So again, another example of how messed up things are. Here's the deal on money market funds. People think money market funds are like cash. I mean, that's why they were invented. They were invented in the 1970s when a lot of usury laws were still on the books. Most of them have been repealed since then. But at the time, remember, interest rates were on their way to 20%. In January 1980, 81, right in there, Paul Volcker talked short-term interest rates to 20%. But there were a lot of usury laws that said the banks could only pay you maybe 10 or 11 or 12. Merrill Lynch invented the money market fund so they could pay you whatever they wanted because they weren't a bank. Anyway, that's a little bit of history. But money market funds were invented as first a cash substitute, and then they later became a cash equivalent. Now, if you call any investor in America or Canada, I don't think it's different, if you're in U.S. money market funds, and say, is your money market fund cash? I go, yeah, absolutely. I can call my broker today, and the money will be in my bank tomorrow. So it's not same-day cash, it's next-day cash. So if you have a big bill, you got to pay a contractor or, settle a closing, whatever, tomorrow, you call up your broker today, Merrill Lynch or whoever, Schwab, whichever one it is, and say, I want you to move money from my money market fund to my bank account, and the money will be there tomorrow, good to go. And so other than the one-day lag, it's cash. Well, last summer, the SEC finalized a rule that says that money market funds can suspend redemptions. Suspend redemptions means I'm not giving you your money back. Now, this has always been true in hedge funds. I've probably read 300 or 400 hedge fund offering documents. I was a hedge fund lawyer for many years, and they all have suspension clauses. You read a hedge fund document, it says, you can get your money back on 30 days notice or 3 months notice, but just in case things get hairy, we don't have to give you your money back. It's called a suspension clause. It's just the way hedge funds work. Well, that's now the law for money market funds. That's new. Now, I'm sure that last August or last September, tens of or hundreds of millions of Americans opened their money market fund account statements, and there was a little, high gloss flyer stuck in the pages that told you this, and I would think that 98% of them threw it in the trash because who wants to read the fine print? But what it said is that, just in case we feel like it, we don't have to give your money back. So in good times, see here's this is what we call conditional correlation. Conditional correlation is when there's no correlation except when there is. So what that means with regard to money market funds, when you really, really don't need your money, you will be able to get it. When you really, really, really want your money, like when the world's collapsing around you, you won't be able to get it. In other words, when banks, like right now, I'm sure you could call your money market fund and have your money tomorrow, but there's nothing really bad going on. But if this emerging markets collapse that we talked about happens, or a replay of 2008, or banks are failing, or they're using the bail-in clause, just things are falling apart left and right, and don't tell me that can't happen, because it's going to happen. When you want your money the most, because you say, I really got to get my money because I want to go buy some gold or whatever, that's when you won't be able to get it. That's when these suspension clauses will be put in place, because every trade has two sides. So you say, oh, gee, I own a money market fund. Well, that's fine. What did the money market fund do with your money? Well, they went out and bought commercial paper from banks. So the point is, well, you think the banks can pay in that world where under Dodd-Frank they're being shut down? So the money market funds need the ability to suspend, because people are going to suspend from them, and they don't want the money market fund managers dumping paper on an oversaturated market. So the whole thing's going to break down. So the short answer is, look, for working capital or some small slice, you might need some money in money market funds, but you are at risk to an asset freeze. Now, say, what can you do? You can't walk around with $100 bills in your pocket, or at least if you get too many, they'll think you're a drug dealer. But what you can do is have short-term treasuries. I'm not a fan of how the government runs its finances, but I do think that 30-day treasury bills, which pay almost nothing, but they are liquid. So very short-term treasury notes owned directly will be liquid. You should be able to get those. So the extra little yield that you get by being in a money market fund, nothing's free. Think of the yield. Think of the delta between the yield on the money market and the yield on the treasury as the premium that you get for selling a put option, because things get bad, you're going to be stopped out. You're not going to be able to get your money back. So in effect, you're selling an option. You probably an option not to pay your money, and you probably don't even realize it.
Okay, that was an excellent answer. The next question that we have comes from Juha, and the question is, how far can NIRP, or negative interest rate policy, go? Are we going to have 2% central bank interest rates in a few years? And is something going to break if this continues like this?
When I was in high school, there was a dance craze called the limbo rock. And the limbo rock was two people would hold what they called the limbo stick, which was usually bamboo, or it didn't matter, it was some kind of stick. And you'd form kind of like a line dance, but when it was your turn, you had to bend backwards to get under the limbo stick, and that was the dance. And really sort of acrobatic people could put their fingers on the ground, or sometimes that was against the rules and you'd fall down or whatever. But the song that they played, the limbo rock, at one point the chorus said, "How low can you go?" And that was the point of the dance. Well, same thing with negative interest rates. It's a big psychological and operational and policy threshold. Going from 0 to like -1 basis point is a very big deal. But once you do, what's the limit? How low can you go? I mean, why not -1, -2, -3? Again, I think crossing the threshold is a very big deal, but we've crossed the threshold. We're through it. It wasn't like Y2K, although Y2K turned out to be a non-event. But remember Y2K on January 1st, 2000, everybody was concerned the computers wouldn't work because they'd all been programmed to have 1999, whatever, and a lot of programs didn't account for the 20, so but it turned out to be non-event. Well, this was similar. Could you actually program the computers to deduct money from people's accounts instead of adding money to people's accounts? And the answer is yeah, no problem. So now that we're across the threshold, I think they can go as low as they need to go. Now, what's the significance of it? Let's just talk about what it actually means. What the central banks are trying to do is to get to negative real rates. Negative real rates. Negative real rate just means that the interest rate they pay you is lower than inflation. What that does, a negative real rate steals money from savers and gives it to borrowers. So, for example, if inflation is 3%, but interest rates are 2%, if I'm an investor, I'm losing money in real terms. I'm losing 1% a year because I'm getting 2% interest, but my money's worth 3% less. So I'm actually losing 1 percentage point a year. That's what a negative real rate does. The central banks want that because it's a great incentive to borrow. If borrowers win and lenders lose, Well, we want people to borrow because we want people to spend money they don't have to increase aggregate demand and follow all these Keynesian cookbook recipes and get the economy moving. So central banks are trying to get to negative rates, negative real rates. Well, how do you get to a negative real rate if there is not only no inflation, but if we actually have deflation? So deflation of 1% with an interest rate of 2% is a real rate of +3. You have to take the 2% nominal interest, and actually normally you take nominal interest and you subtract inflation, that gives you the real rate. But I think we all learned in the 6th grade, when you subtract a negative, you have to add the absolute value. So that equation looks like 2 minus -1, which is 2 plus 1 equals 3. So the real rate is actually quite high. So when people say, gee, interest rates are really low, I say no, they're not. Interest rates are close to an all-time high. Nominal rates are really, really, really low, but real rates are really high because of deflation. So what's the way to understand the bond market? The nominal rate is chasing deflation down a rabbit hole. And it was the more deflation you have, in other words, the lower the level of interest rates. Just think of zero as not being a boundary, just going from +1 to -1. Think of that as down 2. The more deflation declines, the lower the interest rate has to go until you get to a negative real rate, because the nominal rate has to be lower than the deflation. So in theory, to get to a negative real rate, you'd have to have something like 2% deflation and -3% interest rates. Just think about that for a second. 2% deflation with a -3% interest rate would be a -1% real rate, which in theory is supposed to encourage borrowing. Although I think if we ever got to that position, most people would be running for the hills. This is all where the eggheads get it wrong, because they can do the math, but they can't do the psychology. So short answer to the question is, I think there's no limit to how low rates can go. There is some limit, because actually the second part of the question was brilliant, which is something going to break? The answer is yes, something's going to break. In other words, on the way to trying to get nominal rates below deflation through financial repression, they're going to print too much money, they're going to destroy confidence, there's going to be something coming up in the exchange rates. Remember, interest rates are just reciprocal to exchange rates. So you mess with interest rates this much, you're going to break the exchange rate. That's what the currency wars are all about. So I think that for now, nominal rates are going lower. There's no theoretical limit on how low or how negative they can go. Nominal rates are chasing deflation down. That's why I look for U.S. 10-year notes to get down to 70 basis points. Why not, right? And but in the process of doing that, we're in totally uncharted territory. The central banks don't know what they're doing. Something's going to break, and again, another reason to have some cash, have some treasury bills, have some gold, outside the banking system. That's your insurance against all these bad outcomes.
Very good. Next question is from Lorna S. And the question is a really good one, because I think there's a lot of confusion in the marketplace about what actually constitutes owning physical gold inside and outside of the banking system. Her question is having your gold in a bullion bank the same thing as outside of the banking system?
Absolutely not, and that's probably the worst place to put it, for two reasons. Number one, anything in a bank vault, et cetera, is at risk to regulatory shutdown. But beyond that, when you buy gold from a bullion bank, and I think we're talking about the LBMA, that's the London Bullion Market Association, and there are lead bank members of the LBMA, and it's all public, it's easy to look up. There's 7 or 8 of them, but it's, what I call the usual suspects: Goldman Sachs, HSBC, Scotia, a few others. When you buy gold from them, they sell it on what's called an unallocated basis, and they have a standard contract, so read the contract, painful as it may be. And what that means is that they sell you gold, but you don't actually have physical gold. And they say that in the contract. They say you do not have bars, serial numbered, inventoried bars that belong to you. What you have is sort of an unsecured claim on some gold. And if you say, oh, well, I actually would like my gold, please. Well, you have to do a bunch of stuff. First of all, you have to give them notice. Then you have to pay more. And then you have to, worst of all, you have to wait. And I know Alex has, and I have, and others have heard horror stories about people who did this, and a month went by, 2 months went by. They said, come back next week, come back. I mean, they couldn't get the gold. What that means is that the bank is out there in the market talking to wholesale dealers, trying to cover a short position, trying to get some physical gold. There is easily, it's impossible to know the exact number because this market is all over the place and not everyone has all the information, but there is easily 100 times more in paper short positions, if you count the COMEX and these unallocated gold forwards, than there is physical gold. If all the people who had a paper claim on gold said, give me the physical, it's not even close. The price of gold would skyrocket overnight, and they'd shut down all the contracts, send you a check for yesterday's closing price. You would not get today's closing price. It'd be a nightmare. So two reasons why that's not a good idea. One, even if you had allocated, you're in a vault that can be seized by the regulators. And two, you don't have gold. You have a paper claim. Now, when you go to certainly Physical Gold Fund, our host on the call today, but there are others, but Physical Gold Fund is my favorite and the one I'm most acquainted with. And I've actually had the pleasure of going to Switzerland and visiting the vault, not just with the sponsors, but with outside auditors and lawyers and tons and tons of security. But we went into the vaults, and actually comes out in a crate, and they got to open it up, and there's your gold. And auditor, we had a list before the crate was opened, and the list had serial numbers on it, and then the crate was open, and not us, but the auditors sat there, checked every number against every number on a bar against every number on the list, everything checked out 100%. So that's when you know you've actually got the gold. And this vault operator, one of the largest secure logistics firms in the world, is not a bank. Now, interestingly, we had a very pleasant meeting after we saw the gold and said, okay, all the gold's there, that's good. Interestingly, we went in and met with the head of logistics, and we just said, how's business? Just having a little coffee there in Switzerland. And he said, business is great. He said, we cannot build the vaults fast enough. We're actually in negotiations with the Swiss Army to take over some fortifications that have been abandoned by the Swiss Army, inside of mountains, which we can use for vault space in future. By the way, if you know anything about the Swiss Army, those vaults are nuclear bomb proof. You could drop a nuclear bomb on it and it wouldn't affect what's inside. He said, we can't build the vaults fast enough. And we said, where's the gold coming from? He said, well, a lot of it's coming from Swiss banks. In other words, it was coming out of UBS and Credit Suisse, going into whether it's Viamat or Brinks or G4S or, some of the other big secure logistics providers. So the big money is well aware of this. They're getting out while the getting's good. So I'll wrap up there. But short answer is I'm a big fan of physical gold. Don't go all in. I think 10% is a fine allocation. Most people don't have 1%, so there's a lot of headroom between 1% and 10%. But even if you're a 5% person, whatever it is, do it in physical for security. It's hard to beat the Physical Gold Fund. As I say, I've been to their vaults, and that gold isn't going anywhere, and it's quite safe. So that would be my recommendation.
Very good. Thank you also for the kind words there, Jim. Okay, so the next question came in by email. This question is from a gentleman by the name of Jordan T., and is asking, is dollar strength basically the same thing as interest rate hikes? And also, could the euro fall even more than it has, and can it really get out of hand? In other words, something like the Russian ruble, et cetera, where we're looking at these charts and they're kind of going straight up and to the right.
Well, I love the second part of the question about how low can the euro go, because one of my favorite vacations, I was in the Swiss Alps in a town called Megève when the euro is 81 cents. All these people, they see the euro drop recently from kind of 130 to where is it right now? I think it's about 106. Let's check the ticker. 106 today. So the euro dropped from 130 to 106. Like, oh, it's the end of the world. Well, I was in Europe when the euro was 81 cents, 0.81. There was no one handle. It was great because we'd go out to dinner and we'd have, a 4-course meal at a great French restaurant, order wine, dessert, after dinner drinks. And we couldn't spend, for a party of 7, we couldn't spend $100. That's how low the euro was. So for Americans, it was great. So I don't get too bent when I see this because remember the IPO price for the euro was $1.16. That's where it came out. It has traded as high as $1.60. And as low as 80 cents. So there's a wide range of what the euro can do. So if you say, could it go lower? Of course it could go lower. Like I say, I was in the French Alps when it was 81 cents, so it could go lower. Will it go lower? That's the question. It's a good question. I guess the right answer is it could, but think about what that means. Because the euro doesn't go lower by itself. If the euro is going lower, that means the dollar's going higher. See, that's the great thing about analyzing cross rates. It's a zero-sum game. If something's down, something else is up. So could the euro go lower? Yes. But that means the dollar's getting stronger. Well, what does that mean? That means more deflation, a slower U.S. economy, the Fed getting further away from their inflation goal, a lower likelihood of the Fed raising rates. In other words, it causes all kinds of headaches in the United States. So there's no free lunch here. So look, my view is that the euro's kind of at the low end of where it's going to go. But again, I don't want to put a stake in the ground on that. If it goes to 99 cents, don't tell me I'm an idiot because maybe it will. But I do think it's kind of at the low end. But even if it does go lower, two things. Number one, that's not good news for the U.S. economy. It's not good news for corporate earnings. It's not good news for the U.S. stock market. It's not good news for Janet Yellen. So think about, don't just focus on the rate and get into a binary, up, down, right, wrong kind of mindset. Think about the dynamics and what it really means. So I think it's at the low end of the range. It could go lower, but if it does, that's really bad news for Janet Yellen and U.S. stocks. So let's kind of leave it there. The first part of the question, is a stronger dollar the same as a rate increase? Absolutely. That's why I said, the way to understand exchange rates and interest rates is they're kind of reciprocal. They're two sides of the same coin. Generally, there are all kinds of exceptions and leads and lags, but generally speaking, higher interest rates mean a stronger currency, but the opposite's true. A stronger currency is the same as a rate increase, even if the Fed says zero. So, and that's what we're experiencing right now. So maybe the way to think about it is, easing, tightening. And this is what my first book is about, the currency wars. In The Death of Money, I talked a lot more about, The Death of Money is my second book. I talked a lot more about instability in the international monetary system and the role of gold. But in my first book, Currency Wars, I talk more about these kind of dynamics. And this is not just pop economics. It was very rigorous economic research that had a big influence on Ben Bernanke when he was still at Princeton before he went to the Fed, that says when you are at the zero bound, you can still ease by cheapening your currency. And that's what started the currency wars. And the opposite's true. When you want to raise rates, you can tighten by raising your currency, even if you don't raise rates. So in effect, the Fed's getting the rate increase without raising rates just by a strong dollar. But it begs the question, do you want to raise rates too, or is that doubling down? It might be doubling down.
Okay, and that about does it. We're out of time. We still have another easily dozen questions in the queue, and I just want to really quickly thank everybody who has sent questions in, both by email. Some people tend to send questions in by Twitter, but also ask live on this webinar. They've all been really great questions, some very smart questions, and hopefully we'll be able to answer some of these maybe the next time around. And with that, I'll hand it over to John.
Thank you, Alex, and thank you, Jim Rickards. Just picking up on that very characteristic remark. They can do the math, but they can't do the psychology. For me, what makes these discussions so illuminating is this multidimensional perspective that you bring to the issues. So thank you for that. And thank you to our listeners. You can follow Jim Rickards on Twitter. His handle is @JamesGRickards. And let me remind you that you can find recordings of all the Gold Chronicles webinars with Jim Rickards online. Visit the website physicalgoldfund.com/podcasts. and register for updates. So goodbye for now, and we look forward to joining you again soon.
You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.